Greetings, Russell McKee here with the 10th paper for our fall seminar Saturdays. And today's paper is about why bank loans cost more. Why do firms pay more for bank loans? The role of renegotiation is the name of the paper. It's by Zhuolu, which was in this paper was presented at WFA 2025. If I mispronounced your name, I apologize. I probably did. This is a solo paper. It appears to be the author's job market paper as well. This author just recently graduated. Best of luck on the job market, and at your first placement. So, corporations have a lot of different ways to borrow. When we teach our students capital structure in, say, an introductory class, we focus mostly on the choice between debt and equity. That's probably the big thing we focus on. But debt and equity are big categories. There's a number of different ways you can issue equity or borrow. If you're borrowing, the two big ways you might do it are borrowing from banks or issuing corporate bonds. And consistently, people have found that bank loans are more expensive. And the question is, why would they be more expensive? And since they are more expensive, why aren't companies avoiding bank loans, which would then push the price of the loan down and equalize the price with corporate bonds? Because we teach in corporate finance, companies are trying to raise money cheaply. So is this not true? Are companies making bad choices when they choose to go to the bank? Well, probably not. Companies rarely make really obviously bad mistakes for long periods of time and large numbers of companies, not just a few companies. Instead, there's probably something about the bank loans that are different from the corporate bonds that make the bank loans more expensive and still worth it. There's maybe there's some other type of benefits that you get from the bank loan that compensate the borrower for that higher interest rate. And it's a pretty large difference. So the author replicates from previous papers, particularly a paper by Schwert in 2020. And bank loans are basically 1% more, 1 percentage point more than the corporate bonds. 95 basis points, 100 basis points would be 1%. And a 1% difference is actually quite large. You're borrowing tens of millions, maybe hundreds of millions of dollars in this transaction, and you're paying an extra 1% interest rate on $100 million. That's a lot of money. This is, if it was like 5 or 10 basis points, you could think, well, maybe it's just because of some frictions in the different markets, and there's no way to sort of arbitrage this down. But a 95 basis difference is huge in a large, pretty efficient financial market, which debt markets are pretty large and pretty efficient. And so the author proposes, as the title suggests, that the reason bank loans are more expensive is because borrowers have an easier time doing a renegotiation for bank loans versus bonds. And this does make sense because if you have to do a renegotiation, so let's say your company, you borrowed money a couple years ago and things aren't going well. You are struggling to make your interest payments, or you're projected to struggle to make your interest payments in the near future. And instead of, you could go to bankruptcy court. You could file for bankruptcy, receive bankruptcy protection, you go through the legal process. It's very expensive and difficult to do. It's not a good thing to go through, both for you and for your lenders, but you could do it. The alternative is to go to your lenders and renegotiate the terms of the contract. Now, this is, of course, bad for the lenders and for you, but it's less bad than going through the courts. Court systems tends to be pretty expensive. But the problem with a renegotiation outside the court system is that it has to be voluntary. So all of your lenders have to agree to change the terms of the contract. If you have a few holdouts, they can stop you from doing the renegotiation. There's actually been lawsuits, major lawsuits involving huge amounts of money, where there were some holdout investors who didn't want to accept the renegotiation, and then were taken to court or went to court to try and stop the renegotiation. So you need basically all of the bondholders to agree, or you need all the banks to agree. Well, there's a lot more bondholders than there are banks. Because when you sell your bonds, it goes on the open market, and there's probably tens of thousands of bondholders. And you got to get basically all of them to agree. You can't even get them all into the same room to talk to you for the renegotiation. Meanwhile, if you had a bank loan, there's maybe a dozen banks that you borrowed from. And a lot of times there's a lead arranger, or one or two or three lead arranger banks. You negotiate with those two banks, and then they'll just tell the rest of the group, okay, this, it's either this or go to bankruptcy court, so we're doing this. It's a lot easier to get a dozen bankers in the room than it is to get 10,000 money managers into the room. And therefore, renegotiation is a hidden benefit that reduces risk for the borrowers. And so that justifies a higher interest rate. If you have lower risk here, you're willing to pay for it. You're paying for it by having that higher interest rate. Now, firms are making a choice here. So there maybe are firms that know that they're more likely to go into renegotiation or need that flexibility. And so they choose loans versus bonds. Like we want to have some sort of causal a way to tell if that renegotiation is causing this 95 basis points difference, or how much of 95 basis point difference is coming from this renegotiation benefit versus potentially other benefits. So we want to have some sort of natural experiment where the renegotiation benefit changes. So that leads us to our empirical setting. Marblegate is a 2014 federal court case in the Southern District of New York. The decision by the district court was reversed in 2017 by the circuit court, the appeals court that oversees cases from Southern District of New York as well as several other states. So if you hear Southern District of New York in law, that just means New York City. That's New York City, probably also Long Island too, but like New York City is what it really covers. It's one of the largest, most prestigious districts in law, because New York City is one of the largest, most prestigious cities in the country. And importantly for us in finance, New York City is a hugely important financial area. So the precedential value of this circuit court case would only apply to the Second Circuit, which includes New York City. But since it includes New York City, a very large number of banks would be affected by this. The effect of the ruling at the district court was to say you can't restructure it. You're not allowed to do it without the unanimous consent of the lenders, which would make restructuring, renegotiation harder, or at least riskier, because you need every single bank to agree. Previously, you needed probably just the lead arrangers or a majority of the syndicate of the banks to agree to it. And if you weren't aware, most bank loans for corporations are not a single bank putting their money at risk for the full, $50 million. You go to the banks, the bank lead arrangers say, okay, we're interested. We're going to go out and talk to our friends, fellow banks, and see how much they are willing to lend it to you. And the whole syndicate will pool their money together to hit that full amount. So each bank is only on the hook for a relatively small portion of the full bank loan that the borrower is taking out. But this court case changed things so that a single bank could hold out and block the renegotiation, force them into bankruptcy court. And the circuit court actually reversed it. But even though the circuit court reversed it, there's now a higher risk that this might happen in the future too. So the data that the author is using, they're using bank loans from DealScan. This is a database about, bank loans. It's literally just about bank loans. I've worked with this database myself. DealScan gives a snapshot of the loans at origination. So it tends to not have it has very incomplete data on anything that happens to the loan after the loan gets originated. There's a different database, one that is controlled by the Federal Reserve, who does a lot of banking regulation, and you only have access to it if you're an employee of the Federal Reserve. That has much better data on loans, but if you're not a Federal Reserve person, DealScan is probably your best bet if you're trying to get loan data, bank loan data. And they have company information from the standard CompuStat that everyone uses, and they use Mergent for bond data so they can calculate bond premium versus bank loan interest rate, and obviously the bank loan was more expensive. So the first thing that the author looked at is what happened to the premium between the bank loan and the corporate bond. And what we're looking at here is the interaction of these two terms. So Marblegate happened, the bank loan court case happened, and this is a company that has a non-trivial amount of bonds, because we need to have some bonds and some loans and see what differences between those two loans, but they're loans to the exact same company. The loan premium goes down. There's a bunch of different models for the regression analysis here, but they're all negative, all significant. So you might note like 95 basis points. Well, this was 83 basis points. So a very large portion of the premium on these loans is disappearing after Marblegate. And this regression is based on years 2015 and 2016. So it's post that district court case that sort of establishes a potential precedent. And then before the appeals court that says, nope, we're not doing that. Okay, so there is some additional analysis that the author does looking at loan characteristics, because within a bank loan, some loans might have characteristics that make restructuring easier. So one example is that if it's been repackaged and sold to a collateralized loan obligation financial institution, it's easier to negotiate because you now have exactly one person you have to renegotiate with, the CLO, because the CLO is in charge of it. So the banks have sold their loan off, so they're not involved anymore. So despite the new precedent, if you borrowed and it was repackaged as a collateralized loan obligation, you still have that renegotiation benefit. So they look at a triple interaction with this LIN indicator, which is basically saying this is a CLO. It has been put into a financial instrument, and the regular negative premium is there, but under the structural model, you're basically regaining that premium when it's in a CLO or other kind of loan instrument like that. So it seems like it mostly affects loans, but only the loans that are the banks still own, which again is where we would think the renegotiation reduction should be happening. And the author also looks at characteristics of the syndicate that gave the money to the company, because the more lenders are on the loan, the harder it's going to be to reach a consensus. And DealScan does tell you some information about all the different lenders on that syndicated loan. So if you have more lenders on the syndicate, that's going to reduce your chance of renegotiation, because all it takes is one bank to say no. Syndicates have what we call lead arrangers that acts as the lead for the syndicate. You can have one, or you can have multiple lead arrangers. If you have just one lead arranger, you have one main person to negotiate with. If you have multiple lead arrangers, you got more people. And if you previously had just one lead arranger, that means you go from just negotiating to one lead arranger to everyone in the syndicate, which might be 10, 20 banks. That's a fairly large number of banks that would get involved in many of these loans. And so they do an indicated variable if the loan had a single lead arranger interacted, and the result of a reduction in premium is even stronger, quite large actually, when you originally had one lead arranger. So before that court ruling, maybe you can just cut a deal with that one lead arranger and renegotiate your debt. Now you can't do that. Meanwhile, if you had a multiple lead arranger loan, you had multiple people you had to negotiate with already. So, it increases, but it's not as impactful as going from 1 to 20 versus 4 to 20. Each additional person, it's a good way to think about it is, well, no, we're not just adding here. They get the negotiations are going to get more and more complicated the more people you are adding, because not only does each individual link have to want to make a deal with you, they have to be willing to reach an agreement on who is losing out in this restructuring, this renegotiation with each other. So if you have 4 lead arrangers, there's 5 parties in the room, all 5 parties have to agree. And maybe you take a Cartesian product of each pair versus if you have 2 people in the room, there's just 1 pair. So it's kind of, it doesn't scale linearly. At least that's how I am sort of thinking about it in terms of why it's going to get worse when you have 3 or 4 lead arrangers versus 1. The author does a number of robustness tests as well. So the author looks at high yield loans. These are loans with much higher interest rate debt. The lender charges more because the loan is riskier. Perhaps we might expect that the benefit of renegotiation only applies for higher risk loans because those are the ones that are most likely to need renegotiation. Not the case. Also, I might be useful. The author probably can't get this data because deals count only gives you snapshots at the beginning. But like, how many loans actually have to? How many times? How likely is it that a loan will get renegotiated? Are higher risk loans, high yield loans, actually more likely to see a renegotiation? Also, the benefit might be smaller if credit quality is expected to rise for the borrower, which would make renegotiation less likely. I'm not showing it because the author uses a really complicated econometric technique that I frankly have already forgotten, even though I've just read this paper, and they find a really small effect, so it's probably not really very relevant. And really, we have this huge, almost entirely removal of that 95 basis points. We've gone from 95 basis points premium to like 5 or 10, which is basically 0. Because of a small effect like that, because it's probably just some noise or frictions, and that we can't really rule out for other things. And that's basically everything for the paper. It's relatively short, which is a little surprising that I suspect it's a job market paper, because usually job market papers just get really long. Your dissertation committee will be like, do this thing, do that thing, do this other thing, and you will shop it around to dozens of universities, and you'll present your paper, and everyone in the audience is like, oh, you should do that, you should do that, you should do that, and then and of course you have to do all those things, and so your paper just gets huge. But this paper was much shorter, and I did cut out a number of robustness type tests, but even so, not that long of a paper. But what we have found here is a really kind of a nice, tidy, pretty focused result here. There's this puzzle. Why are bank loans more expensive than corporate bonds for companies? And it looks like a large portion of that expense is coming from a renegotiation benefit, that you have an easier time renegotiating bank loans than the corporate bonds. That reduces the risk for the borrowers, and they pay more in order to avoid that risk. And therefore, we have saved pecking order theory. Companies are indeed trying to use the lowest cost. They're not purely looking at a simplistic, what's the lowest interest rate? They're also including how risky is this loan going to be for us as part of their capital structure analysis. And then that's why they sometimes go for banks versus going for the corporate bonds. So I can still keep teaching my students that companies will tend to pick the lower cost way of raising capital. I like that result. All right, so that is everything for this week. We have a few more weeks left in the semester, at least that I have prepared these seminar videos for. A couple more with WFA, all WFA papers. I hope you enjoyed. If you did, please comment, like, and or subscribe so that others can find this video too. We professors love talking about research. I would love to chat about the results of this paper. And I hope we see you again next week.